Gold versus stocks, the ultimate investment showdown. Are you ready to unlock the secrets of smart investing? Gold and stocks, two titans of the investment world, face off in a battle for your portfolio. Which one reigns supreme? Let's dive in. Gold has captivated humanity for centuries, and its allure extends far beyond mere aesthetics. It's often hailed as a safe haven, a beacon of stability in turbulent times. But what makes gold such a reliable asset during crises? During periods of economic uncertainty, geopolitical instability, or market downturns, investors tend to flock to gold. This increased demand drives up its price, making it a valuable asset to hold when other investments are faltering. Think of it as financial insurance. Historically, gold has demonstrated its resilience during major economic crises. For example, during the Great Recession, 2008-2012, gold prices soared as investors sought refuge from the collapsing stock market. This highlights gold's potential to protect your wealth when traditional investments are struggling. In 2024, gold outperformed Indian equities, delivering returns exceeding 20%, while the Nifty 50 and BSE Sensex indices achieved gains of approximately 12%. This was driven by geopolitical uncertainties and global economic challenges. This showcases gold's ability to thrive amidst global turmoil. Gold's value often moves independently of other asset classes, making it an excellent tool for diversification. By adding gold to your portfolio, you can potentially offset losses in other investments during market downturns, reducing your overall risk. Furthermore, gold is widely regarded as a hedge against inflation. As the value of fiat currencies decreases due to inflation, gold tends to maintain its purchasing power, preserving your wealth over time. This makes it a valuable asset to hold in an inflationary environment. While gold offers stability, stocks are renowned for their potential to deliver substantial long-term growth. But how do stocks achieve these impressive returns, and what makes them a compelling investment choice for the long haul? Historically, stocks have consistently outperformed gold over extended periods. This is because stocks represent ownership in companies that generate profits and grow over time, leading to increased value for shareholders. The S&P 500, a benchmark index of 500 of the largest U.S. companies, has delivered an average annual return of over 10% since 1957. This demonstrates the remarkable potential of stocks to generate wealth over the long term. One of the most powerful forces in investing is compounding. By reinvesting dividends and earnings from your stock investments, you can accelerate your wealth accumulation over time. This allows your money to grow exponentially, creating a snowball effect. Long-term stock investments tend to outperform short-term trades due to the power of compounding and the ability to ride out market fluctuations. By staying invested for the long haul, you can capture the full potential of stock market growth. Investing in growth stocks, stock funds, and dividend stocks can provide significant long-term growth potential. Growth stocks offer the potential for high capital appreciation, while dividend stocks provide a regular income stream. Schwab's 2025 Outlook projects that U.S. large-cap equities are expected to deliver annualized returns of 6% over the next decade. This suggests that stocks remain a compelling investment choice for long-term growth. Every investment comes with its own set of risks and rewards. Understanding these factors is crucial for making informed decisions that align with your financial goals and risk tolerance. Let's examine the risks and rewards associated with both gold and stocks. Risks. Price volatility. Gold prices can be volatile in the short term, influenced by factors such as interest rates, currency fluctuations, and geopolitical events. No regular income. Gold doesn't generate income through dividends or interest. Returns rely solely on price appreciation. Storage costs. Physical gold requires secure storage and insurance, adding to the overall cost of ownership. Opportunity cost. Gold may underperform stocks during periods of strong economic growth, representing an opportunity cost for investors seeking higher returns. Rewards. Safe haven. Acts as a safe haven during economic uncertainty and market downturns, preserving capital when other investments are struggling. Inflation. Hedge. Can protect against inflation, maintaining purchasing power as the value of fiat currencies declines. Diversification. Diversifies a portfolio and reduces overall risk by providing a hedge against market volatility. Risks. Market risk. Stock values can fluctuate significantly due to market conditions, economic cycles, and company-specific news. Volatility. Stock prices can rise and fall rapidly, creating uncertainty for investors. Capital loss. Investors can lose their entire investment if a company performs poorly or goes bankrupt. Inflation risk. Stocks may not always keep pace with inflation, potentially eroding returns over time. Rewards. Higher potential returns. Stocks offer the potential for higher returns compared to gold, driven by company growth and profitability. Dividends. Some stocks pay dividends, providing a regular income stream for investors. Long-term growth. Historically, stocks have provided significant long-term growth, creating wealth for patient investors. The best investment strategy depends on your individual circumstances, financial goals, and risk tolerance. Let's explore how gold and stocks can fit into different investment profiles. Beginner investors. For beginner investors, a diversified portfolio that includes both stocks and gold can be a good starting point. Consider investing in low-cost index funds or ETFs that track the S&P 500 or a broad market index. Allocate a small portion of your portfolio to gold, perhaps through a gold ETF, to provide diversification and a hedge against market volatility. Seasoned investors. Seasoned investors may have a more sophisticated understanding of the market and a higher risk tolerance. They may choose to allocate a larger portion of their portfolio to stocks, focusing on growth stocks or dividend-paying stocks. They may also use gold strategically to hedge against specific risks, such as inflation or geopolitical uncertainty. Financial advisors. Financial advisors play a crucial role in helping clients make informed investment decisions. They can assess a client's financial goals, risk tolerance, and time horizon to create a customized investment plan that includes an appropriate allocation to both stocks and gold. They can also provide ongoing guidance and support to help clients stay on track with their financial goals. Staying informed about current market trends and future outlook is essential for making sound investment decisions. Let's examine the current market environment and consider how it might impact the performance of gold and stocks. Economic growth. If the global economy is expected to grow, stocks may offer better growth potential. Companies tend to perform well during periods of economic expansion, leading to increased profits and higher stock prices. Inflation. If inflation is expected to rise, gold may be a good choice to protect your capital. Gold tends to maintain its value during inflationary periods, preserving your purchasing power. Interest rates. Interest rates can impact both gold and stocks. Rising interest rates can make bonds more attractive, potentially leading to lower demand for stocks and gold. Conversely, falling interest rates can make stocks and gold more attractive. Geopolitical events. Geopolitical events, such as wars or political instability, can create uncertainty in the market. During these times, gold may act as a safe haven, while stocks may experience increased volatility. Investing can be complex, but with the right guidance, you can make informed decisions that align with your financial goals. Here are some tips to help you navigate the investment landscape. Do your research. Before investing in any asset, take the time to research its fundamentals, risks, and potential rewards. Diversify your portfolio. Diversification is key to reducing risk. Spread your investments across different asset classes, sectors, and geographic regions. Consider your time horizon. Your time horizon will influence your investment strategy. If you have a long time horizon, you can afford to take on more risk. Rebalance your portfolio regularly. Rebalancing involves adjusting your asset allocation to maintain your desired risk level. Seek professional advice. If you're unsure about how to invest, consider seeking advice from a qualified financial advisor. Gold and stocks can both play valuable roles in a comprehensive financial plan. Here's how you can integrate them into your overall strategy. Retirement planning. Stocks can be a key component of a retirement portfolio, providing long-term growth potential. Gold can provide diversification and a hedge against market volatility. Emergency fund. While gold can be a store of value, it's not as liquid as cash. It's important to maintain a separate emergency fund in a readily accessible account. Wealth preservation. Gold can be used to preserve wealth over time, protecting against inflation and economic uncertainty. Estate planning. Stocks and gold can be included in your estate plan to ensure that your assets are distributed according to your wishes. Before investing in gold or stocks, it's crucial to assess your risk tolerance. This will help you determine how much risk you're comfortable taking with your investments. Conservative investors. Conservative investors typically have a low risk tolerance and prefer to invest in low-risk assets such as bonds and gold. Moderate investors. Moderate investors have a moderate risk tolerance and are willing to take on some risk in exchange for higher potential returns. They may invest in a mix of stocks, bonds, and gold. Aggressive investors. Aggressive investors have a high risk tolerance and are willing to take on significant risk in exchange for the potential for high returns. They may invest primarily in stocks. Gold. Ideal for investors seeking a safe haven, diversification, and a hedge against economic uncertainty and inflation. Stocks. Best suited for investors with a longer time horizon, a higher risk tolerance, and a goal of achieving higher returns through capital appreciation and dividends. Consider current market conditions. If you anticipate economic uncertainty, a recession, or rising inflation, gold may be a good choice to protect your capital. If you believe the economy will continue to grow, stocks may offer better growth potential. Diversification is key. Many experts recommend diversifying your portfolio by including both gold and stocks to balance risk and reward. Your financial goals and risk tolerance. Ultimately, the best choice depends on your individual financial goals, risk tolerance, and investment time horizon. Don't let uncertainty hold you back. Now is the time to take action and build a portfolio that aligns with your goals. Subscribe to our newsletter for expert insights, subscribe to our channel for valuable tips, and schedule a consultation with a financial advisor today. Your financial future starts now. Future.